Disclaimer. Have you ever walked into a room and felt something instantly? Nothing looks broken. Nobody is arguing. The lights are on. Music is playing. People are smiling like everything is perfectly normal. But deep down, something feels off. That's exactly where silver is right now. Silver is sitting at what appears to be a perfect equilibrium point. Balanced, calm, almost boring. It feels like the market finally cooled down and found stability. It's up roughly 30% from the recent bottom and down roughly 30% from the recent top, stuck in the middle. And that is precisely why this video matters. Because historically, when silver looks the most stable on the surface, that's often when structural stress starts forming underneath. The floorboards don't crack loudly at first. They weaken quietly. And here's the uncomfortable truth. Most people will not connect the dots until it's too late. Because the first signs of damage don't usually appear in price. They appear in the plumbing, the behind-the-scenes mechanics of the market. Before we go further, listen carefully because this is about your safety and your money. I'm Chill Guy, and I need to clarify two things clearly so no one gets misled. First, I only have one backup channel. 1. The handle is OG Chilger2. There is only one video uploaded there. The link is in the description of this video and in this channel's description. They can copy my name, they can copy my thumbnail, they can copy my logo, but they cannot copy the handle. Always verify the handle before subscribing. And let me be crystal clear. I have not uploaded any silver or metals update videos on that backup channel. It is strictly an emergency backup. All daily updates stay here. Second, the copycat situation is becoming dangerous. Just hours ago, I saw a channel that was an exact replica, same thumbnail, same logo, claiming silver is trading at $50. Completely false. That's why verification matters. They are here for clicks. I am here for legacy. I have skin in the game. They don't, and what's worse, many copycats, and even some so-called mentors, watch real analysts with a notepad in hand, copying talking points they don't fully understand. So protect yourself. Verify everything. Now let's go back to the data, because the numbers right now are telling a story, and it's not a comfortable one. As I'm recording, Western Spot Silver, $80 silver futures, $80 Shanghai Spot, $88 Shanghai futures, $90, that's roughly a $6 premium holding steady from the previous update. And that premium is not some trivial detail. It's the market whispering that something is misaligned. In a normal functioning market, arbitrage closes that gap quickly. Traders would buy in the cheaper market and sell in the more expensive one until the spread disappears. But the gap is not closing, which tells you something important. The paper price is one reality. The physical market is another. Eastern physical markets are paying higher prices. Western paper markets continue behaving as if they control pricing. Historically, disconnects like this do not resolve quietly. They resolve forcefully. Now, let's move beneath the surface, because this is where most people stop looking. COMEX registered silver just fell below 100 million ounces for the first time in modern tracking history. That psychological level matters. Registered silver represents metal that is actually available for delivery. After nearly 5 million ounces drained in a single day, total registered now sits around 98 million ounces. Now here's where the math becomes uncomfortable. March open interest recently stood around 65,000 contracts. Each contract represents 5,000 ounces. That equals approximately 325 million ounces of paper claims, against 98 million ounces of registered physical silver. That's a paper-to-registered ratio of roughly 3.3 to 1. Some people will say, that's normal. It can be normal during calm periods. But ratios like that become dangerous when delivery windows approach. First notice day is February 27th. That's about 2 weeks away in this setup. And once first notice day gets close, the dynamic shifts. It stops being about trading and starts being about settlement pressure. Now, if you're a short-term trader, let's address the technical situation clearly. In the previous update, I mentioned that silver had reclaimed the 150 exponential moving average, EMA, on the hourly chart, and that it could act as support. As I'm recording this now, price has moved back below it. That means it failed the support test. Below the 150 EMA, that level becomes resistance. Structurally, from a short-term chart perspective, silver could move lower. This is not a buy signal. This is not financial advice. This is chart structure education. I will be introducing more advanced tools soon: volume profile, order flow analysis, sentiment indicators. But understand something clearly. Do not follow anyone blindly. Use your own thinking. Protect your capital first. Capital preservation comes before opportunity. Now let's zoom out. Silver rallied from roughly $63, $64 up to about $93, roughly a 30% move. Then it corrected back to around 82, roughly 30% down from the high. So both narratives feel valid. Bulls say the upside has been proven. Bears say the downside risk is real. Price is compressed between two opposing stories. Paper traders see resistance. Physical buyers see value. That compression is rarely permanent. Now, fundamentals. The Silver Institute recently released its outlook confirming this is the sixth consecutive year of structural deficit. Projected deficit, 67 million ounces. Let's break this down carefully. Investment demand surged 20% to 227 million ounces, a 3-year high. India alone is projected to import roughly 220 million ounces, about 25% of total global annual mine supply. That's documented import data. Industrial demand, roughly 650 million ounces, down about 2%, mainly due to solar efficiency gains. Thrifting. Mine production, up about 1% to around 820 million ounces. Recycling, up 7%, surpassing 200 million ounces for the first time since 2012. Yet even with higher production and more recycling, we still face a sixth straight deficit of 67 million ounces. That means above-ground inventories are being drained year after year. Now zoom further out. China's combined holdings of U.S. treasuries, stocks, and bonds have declined significantly over the past 14 years. Official treasury holdings recently fell to roughly $682.6 billion. China has also reportedly encouraged banks to reduce exposure to U.S. treasuries. These are not isolated headlines. When a major holder of dollar-denominated debt reduces exposure over a long cycle, capital tends to shift toward commodities, infrastructure, and tangible strategic assets. Layer on top of that rising global uncertainty metrics, now exceeding pandemic and financial crisis levels. In environments like this, markets don't move smoothly. They move in waves of stress. As Jesse Livermore wrote in Reminiscences of a Stock Operator, the big money is made in the big swing, not in the daily noise. The multi-year silver deficit combined with geopolitical repositioning is a potential big swing setup. Now timing. The Shanghai Metals Exchange closes from February 15th through February 23rd for Chinese New Year. That's 8 days where the Eastern physical market is offline. Historically, price pressure sometimes appears during these windows because the physical bid is temporarily absent. But here's what makes this time unique. Shanghai was already in record backwardation before the holiday. Backwardation, where near-term contracts trade above later months, often signals tight supply and urgent demand. Reports also indicate short sellers paying deferral fees to avoid delivery. That is not a casual market condition. Now let's address macro stress signals. Bankruptcies have risen. Consumer default rates are elevated. The labor market shows early signs of weakening, yet commodities remain strong. Silver up dramatically year over year. Gold up significantly as well. That divergence suggests monetary debasement interacting with supply constraints. As Ray Dalio explains in his work on debt cycles, large debt cycles often resolve not through immediate collapse, but through currency devaluation that reduces real purchasing power. Now another structural shift. Texas has announced plans to produce gold and silver coins approved for IRA and 401k use for residents, with involvement from Scottsdale Mint. If other states follow, Florida, Wyoming, Montana, that could expand structural demand through retirement accounts. That's not short-term speculation. That's potential infrastructure-level demand. At the same time, firms like Morgan Stanley have projected massive long-term growth in rare earth magnet demand, materials heavily dominated by Chinese production. Strategic material independence is becoming a decades-long theme. Now back to COMEX, nearly 5 million ounces drained in a single day. registered down to around 98 million ounces. March open interest still around 325 million ounces in claims. February deliveries exceeded 100% of open interest. If March follows similar patterns, the delivery test could be significant. SLV also experienced heavy flows, stop losses triggered, month-end settlements executed, yet physical tightness persisted. So either banks buy back shares and futures to manage positions, or pressure increases toward delivery. Now honesty requires acknowledging the bearish case. Contracts can roll. Cash settlement exists. Shanghai closure may create temporary downside. Technicals weakened below the 150 EMA. The economy has not fully collapsed. The system has tools. But here's the counterweight. 6 consecutive deficits. Rising investment demand. India imports at 25% of mine supply. Persistent Shanghai premium. COMEX registered below 100 million. Delivery ratios elevated. Backwardation present. These are multiple pressure points tightening simultaneously. So here's what matters going forward. Shanghai closure. February 15, 23. Shanghai reopens. February 24. First notice day. February 27th. Watch March contract behavior. Watch the $6 premium. Watch the 150 EMA reaction. Watch delivery intentions. This is not a trade call. It is a structural warning. Verify the data. Think independently. Protect your capital. Because when the headlines finally explain what happened, the easy part of the move is usually already over.